You're watching Insightful Value, the go-to source for spotting companies that the market has overlooked. And here's one you probably didn't expect: Fiskars. Yep, the orange-handled scissors company. But there's way more to it than that. Today, we're diving into why this 375-year-old Finnish giant might be quietly sitting on deep value territory. As always, this review is for informational and educational purposes only and is not financial advice. So let's talk about Fiskars. Founded in 1649, Fiskars is one of the oldest companies in the world still operating today. But don't let the legacy fool you. This is a modern business with a strong portfolio of consumer brands. Beyond scissors, they own a range of globally recognized names like Iittala, Royal Copenhagen, Waterford, and Wedgwood. Their product lines span premium home, kitchen, and gardening tools, with a strong emphasis on quality, design, and Scandinavian heritage. Now, what's interesting is how the stock has underperformed lately, and that's where the opportunity might lie. The share price has dropped significantly over the past year, but not necessarily because the fundamentals are falling apart. In fact, Fiskars continues to generate solid free cash flow and maintains a strong position in the premium consumer goods segment. In their most recent earnings report, net sales came in at approximately $1.1 billion annually. Their EBIT margin has hovered around 9 to 10%, which is respectable for a company in the consumer goods space, especially in a tough macro environment. They also maintain a healthy balance sheet and a decent dividend yield, currently around 4%, which is quite attractive in a low-growth, high-rate market. The company's strategic transformation is worth noting. Fiskars has been focusing on digital commerce expansion, brand consolidation, and operational efficiency, with their Growth Strategy 2025 aiming to drive both top-line and margin improvement. They're especially targeting growth in the U.S. market, where premium home products continue to show strong demand despite broader retail challenges. But let's be honest, there are risks. Fiskars is exposed to fluctuations in consumer spending, especially in Europe, which remains a big part of its business. Supply chain disruptions, inflation in raw materials, and foreign exchange impacts also weigh on margins. And while they're well diversified in terms of products, their brand strength doesn't yet match giants like Procter & Gamble or Unilever. That limits pricing power in tough times. From a value investing perspective, though, Fiskars is trading at a forward PE that's below its historical average and way below many peers in the premium goods space. The company is still profitable, generates consistent cash flow, pays dividends, and isn't drowning in debt. If you're looking for a globally known company with solid fundamentals, a strong brand portfolio, and a temporarily depressed share price, Fiskars deserves a closer look. At Insightful Value, we specialize in exactly these types of stories. Deep dives into undervalued companies hiding in plain sight. We break down the numbers, cut through the noise, and help you understand what really matters. Whether you're new to investing or a seasoned pro, our goal is to make complex ideas easy to act on. You can find more in-depth analysis on Fiskars and many other undervalued stocks at insightfulvalue.com. If you like this type of content, don't forget to subscribe to our channel and visit our site for regular updates. Thanks for watching, and see you in the next one.